Welcome to Caribbean Business Review, where insight meets impact. We bring you economic and financial updates, sharp statistical breakdowns, and data-driven insights on the forces shaping the region. Smart analysis, bold ideas, real Caribbean intelligence. This is CBR. Welcome, everybody. This is the Caribbean Business Review. My name is Joseph Cox. We are at episode 12 in our series, and we just really wish to continue to thank you for your engagement, and we do hope that you will particularly like this week's program. Indeed, our special guest this week in our Strategy Deep Dive segment is Dr. Patrick Antoine, and Patrick is the CEO and Technical Director at the CARICOM Private Sector Organization. We'll be looking at the whole issue of rethinking Caribbean integration. We're looking at it through the prism, really, of tariffs, trade, and transformation. We'll be delving not only into the current, what we call erratic trade dynamics that currently obtain, but we're also looking at the issue of free movement of labor within the Caribbean. Further, in response to what we can only say is overwhelming interest in our recent discussion on this program on regional immigration, especially the Cayman Island reforms, we drew over 129,000 views on TikTok, on our TikTok account alone. We have decided to take a deeper dive into the issue this week. So we'll be looking on our CBR briefing at Cayman's bold bet on jobs, identity, and labor sovereignty as we look at the new immigration or the new emerging immigration order. We also want to bring to your attention two issues of fundamental importance to the region. First, in a landmark decision on July 24th, the Privy Council, the UK Privy Council, ruled that shareholders cannot access a company's internal legal advice in merger disputes. Now, this overturns decades of precedent, and the ruling directly affects Caribbean jurisdictions under Privy Council authority, but it strengthens the legal privilege protections and could reshape shareholder litigation right across this region. So it's something that we need to be very, very mindful of as we continue along this road of development. Further, President Trump has unleashed a sweeping new round of tariffs, this time ranging between 10 and 50% on 69 countries, and that has pushed the U.S. effective tariff rate up to around 18%, and triggered global market turmoil. Indeed, as you look at some of the key partners like Canada, India, and Brazil, they're facing very steep duties. Concerns continue to mount over the broader implications for global growth and inflation. And in fact, in my opinion, this will be indeed inflationary and will adversely affect global growth. But let's see if this is just another negotiating ploy, or this round will at least create some element of market certainty. Also, just quickly alerting you that the August 3rd edition of the Caribbean Financial Dispatch is now available. And as usual, we are inviting you to like, share, and subscribe to the Caribbean Business Review podcast, as it will help us to grow even further. Now, with that, let's turn to Claudine Lloyd for a quick look at what's coming up in this week's Market Watch and Global Pulse segments. Hi, Claudine.
Thank you, Joseph. Coming up in Market Watch, the UK Privy Council ends shareholder access to legal advice in mergers. Moody's reaffirms the CBD AA1 rating on stronger capital and reforms. And Jamaica deepens its global logistics role with a new $50 million port investment. Then in Global Pulse, global markets slide as Trump rolls out sweeping tariffs on 69 countries. Eurozone growth surprises to the upside, easing pressure on the ECB. And the UK introduces the toughest late payment laws in the G7. All that and more this hour on Market Watch and Global Pulse. Coming up next, it's the CBR Briefing.
Welcome to the CBI briefing. I'm Joseph Cox. This week's topic struck a clear chord. Our TikTok explainer on the Cayman immigration reforms drew just over 129,000 views in just a few days, clear evidence of how deeply this issue resonates across the region. So today we are going to go deeper, unpacking not just the headlines but the policy shift behind them. Indeed, there is no doubt that within the Cayman Islands, a sweeping immigration and labor reform agenda has begun to take effect. Anchored in a rebranded national vision, it marks a decisive shift from liberal labor mobility to a doctrine of Caymanian priority. On May 29th, Cabinet approved drafting instructions to amend the Immigration Transition Act of 2022, launching Phase 1 of private sector immigration reform. Among the key proposals, a national workforce database and a workforce plan, job switching rules, reforms to work permits, permanent residency and employment rights certificate, and the right to be Caymanian. Higher income thresholds to support dependents, annual declarations and new administrative fees, a revised PR point system favoring community contribution, stricter compliance rules including revocation for sham marriages or breaches, and partnerships with Chamber of Commerce to align education and industry needs. Symbolically, the legislation will be renamed the Caymanian Protection Act. The stated goal is to place Caymanians at the center of economic opportunity, but what does the data show? As of July 21st, 2025, unemployment stands at just 2.8%. According to the 2024 Labor Force Survey, labor force is 60,828, and employed persons are 59,393. The resident population is 88,833, up 4.8% year on year, but 60% plus of residents are non-Caymanian. This isn't a market in crisis, it's a market in flux. Employment is high, but population growth is accelerating pressure on housing, services, and wage dynamics. The National Workforce Database will include Caymanian graduates, over 1,000 scholarships awarded in 3 years, 65,000 plus annual immigration decisions processed by WORC, nearly 9,000 jobs posted in the first half of 2025, data on fields of study, job gaps, and work permit justifications. This framework aims to close structural mismatches between workforce supply and the labor demand. The new restrictions represent a tightening of the labor gate. Permit holders must remain with one employer for 2 years. Switching jobs after that requires a 6-month exit. Those without permanent residency after 9 years must leave for 2 years. New income thresholds applying for adding dependents. And sham marriages and non-compliance will lead to deportation or status revocation. In fact, one of the more controversial proposals confirmed by Minister Mills involves residency rights for non-Caymanian spouses. Under the draft reforms, if a work permit holder is married to a Caymanian for less than 5 years and the Caymanian dies, the surviving spouse would lose their RERC. The measure is designed to close loopholes and prevent system abuse, but critics warn it could destabilize families and create legal uncertainty for widowed non-Caymanians who may have built full lives in the territory. These rules are designed to curb abuse, but they also signal a broader shift from economic flexibility to state control. The civil service is next. Starting January 1, 2026, new term limits will apply to non-Caymanians. Mandatory 2-year break before re-employment, restrictions on private to public sector transfers, reserved roles for Caymanians, contractual obligations for non-Caymanian officers to train Caymanians, and of course this complements the succession planning pilot launched in July, starting with the Chief Human Resources Officer post. But this is more than immigration reform, it's systemic redesign. The Cayman Islands Cabinet is now coordinating across the Ministry of Education, Ministry of Caymanian Employment, and the Chamber of Commerce to roll out internships and apprenticeships, formal skills to jobs pipeline, real-time data sharing across ministries. In short, Cayman is building a new governance model, one that fuses identity-based immigration, data-driven labor planning, strategic gatekeeping in both the public and private sectors. The Caymanian Protection Act marks a shift from short-term labor flexibility to long-term workforce sovereignty, and this isn't happening in a vacuum. In the Turks and Caicos Islands, policymakers have implemented similarly restrictive frameworks. Officials now routinely withhold passports from transit passengers, citing security concerns. Work permit holders in TCI are bound to a single employer and cannot switch jobs without employer reapproval. Further, they must leave the territory and reapply from abroad if they want to change jobs. There is no credit for prior residency towards permanent status if they switch employers. Under proposed amendments, unskilled workers may be limited to 3 consecutive years on island before being required to exit for at least 3 months, and permanent residence eligibility could stretch from 10 to 15 years of continuous legal stay. These parallel moves suggest a regional trend, or Caribbean recalibration, where small states are redefining the balance between openness and ownership. These systems reflect a common philosophy: restrict circular immigration, anchor work permits to employer control, and extend the road to long-term settlement. Together, Cayman and TCI signal a Caribbean pivot, from reactive labor market access to proactive population and sovereignty management. But with Cayman's unemployment near historic lows, the question remains: are these reforms about protecting opportunity or controlling identity? Can Cayman remain competitive while tightening the rules of access? And will others follow this model or seek a different balance? We'll be watching how the January 2026 reforms roll out and how employers, workers, and regulators respond. Now that's it for this edition of the CBR Briefing. I'm Joseph Cox.
In a world of constant change, insight is your greatest asset. At Joseph Cox and Associates, we empower innovation across the Caribbean. Whatever your challenge, we can help. We're proudly customer-centric, offering bespoke solutions tailored to every partner. From innovation and digital transformation to leadership and policy, our services are designed to deliver lasting impact. We partner with leaders across sectors, from finance and government to energy, tech, and infrastructure, helping them navigate complexity with confidence. Our work is grounded in collaboration. We connect regional leaders through powerful networks, driving change through joint research. Discover more at josephcox.org. Joseph Cox and Associates. Insight, experience, impact.
Okay, welcome back to the Caribbean Business Review. My name is Joseph Cox, and today we have our special guest, Dr. Patrick Antoine, and Patrick is the CEO and Chief Technical Director at the CARICOM Private Sector Organization. And as you hear that, I mean, CPSO has been in the news so often nowadays. It's really difficult sometimes to pick a topic just to have a conversation because their reach is wide and the effect is clear. But Patrick, we want to talk to you today about trade, as well as we had some recent developments in terms of free movement. We also have to look at it within the context of like treaties and how we're really moving forward with this sort of thing. But let me start with trade with you as I welcome you to the program. All of a sudden, the CPSO and the World Bank, I believe, put out a study that said the region will be faced with something like 540 plus million loss based on what's going on in terms of the tariffs and the change in dynamic. My first question to you is, given all that has happened subsequent to the publication of that study, are the assumptions still holding? Is the information, because it's such a fluid environment? How should I interpret the data emanating from that frame?
Well, thanks a lot, and really, it's always a joy to be discussing these matters with you because I think they're so important to the community. and any opportunity that we have, I think, to share perspectives that will help to give the private sector some direction, and also governments some perspectives from the private sector on how we view things. I think it's pro-community, pro-CSME. At the end of the day, that really continues to be the voyage that we're on, which of course has two components. And the question that you've raised actually spans the two components. The first component being how we sort of engage in production and trade amongst ourselves. And of course, the second dimension is how we engage in trade and economic relations between CARICOM and the rest of the world. And our principal trading partner is the United States. So here's the thing. Very succinctly put, are the assumptions still valid? The assumptions that we made in the analysis that we did as part of the expert working group with the CARICOM Secretariat, the CDB, and the World Bank still hold good. The way that we have done the model allows us to make some assumptions, whether it's 10% or zero. The interesting thing for those listening, why I think that the model gives us some pretty solid answers based on what was announced as reciprocal tariffs, is because we had a situation where the trade that we engaged in with the United States before under the CBI, I'm using the CBI as a catch-all for the Caribbean Basin Economic Recovery Act and the Caribbean Basin Partnership Trade Act. The CBI collectively allowed us to export into the United States duty-free for most of the tariff lines. There were a few exceptions. So the data that we have actually captures how the duty-free trade with the United States look. And the reciprocal tariffs allows us to then put on top of that, in a unique setting, what would 10% look like? And in measuring what the 10% looked like, we were able to double check that. Young people will say double click against what we were seeing emerging. And we're pretty confident that what we have seen emerging is very close to what we estimated. And it's not often that economists get an opportunity to look at the policy situation is with and what it is without having to simulate it in the abstract. And so, because we have this sort of quasi-abstract, but quasi-realistic way of looking at it, the estimates are pretty solid. But your question was, look, is it still valid given everything that's happened since? So we've had announcements by the administration in the United States, which, quite fleetingly suggests that they may be looking at imposing tariffs a little above 10% on, broadly, generally speaking, with a wave of the hand is how it came across to me, the Caribbean countries and the countries in Africa. And the other thing that's happening is that there is a biannual review of the CBI, operations of the CBI, for beneficiary states taking place at this time. This biannual review is every 2 years, where the USTR, United States Trade Representative's Office, does this sort of economic, technical, and trade analysis with some other criteria to make a report to the Congress on whether, in fact, the countries have been, on how the countries have been performing under the CBI. So what we have done in this unique setting is that we've been able to make a submission by the regional private sector, which looked at what trade under the CBI looked like, but we were also able to report on what the results of that trade was beginning to look like without the CBI preferences. Very interestingly, that allowed us to use the biannual sort of reporting process to make the case that the CBI preferences, now that the reciprocal tariffs were on of 10%, that the CBI preferences were really important to the states in the Caribbean, the beneficiary CBI states, which would be all of the states that you know, except for Suriname. And that allowed us, I think, to put a unique position, which we hope that the administration begins to listen to. And that unique position, which has not changed, is that the United States has a trade surplus with CARICOM. Of all of the countries in Latin America and the Caribbean bloc is a bloc for which the U.S. has sustained a trade surplus for the last 2 or 3 decades. In Jamaica's case, there's probably 1 year since 1965 that there wasn't a trade surplus very early, which the United States did not maintain a trade surplus with Jamaica. For the rest of the region, the OECS countries are small service economies, and we continue to hammer that point. And if there's one point I want to make today, because I know my colleagues in the US at technical level and certainly in the embassies and the missions listen, it is that CARICOM is in a different position. What the US is trying to achieve with the rest of the world, they've already achieved with CARICOM. And pushing the envelope more in terms of tariffs with CARICOM and will disrupt supply chains. It will disrupt investment and employment patterns. And it will certainly cause the US trade surplus over time to diminish, because the countries will have no option but to look for alternatives. And that is the hardcore economic story. It's not ideology. Yes, it has nothing to do with a shift from the perspective of the Caribbean countries from one set of, let me just say ideological leanings to another. It is pure hardcore economics in which our private sector is intrinsically and indispensably up to this time joined with the private sector in the United States. So yes, the study is still very much valid in the context of what has happened since. And, your program must make the point loud and clear in Jamaica to those who would listen that we need the CBI preferences. And then there's a but.
Well, what can I say? You're right, there is a but. But the other aspect of it, for where we sit thus far, is it that the companies, because, well, contrary to the narrative pushed in the States, it's the actual importing country that absorbs the tariff, that you have to get the tariff. But is it that the purchasers of our exports, our regional exports, is it that they have been by and large absorbing the tariffs, the new tariffs, or have they been passing it on? Because one is kind of mindful. There's been a lot of stock taking, inventory, pre-purchasing that's going on as people try to hedge their bets against the tariff, the changes in tariffs. But at the same time, that can't last forever. So from where you sit thus far, are we seeing that kind of, is there the transmission mechanism straightforward, or are people absorbing the tariffs, or what's going on?
We're seeing 3 discernible patterns. The first pattern is there are some sectors, and we don't want to name them yet because the guys are still talking, for which the purchasers are saying, we can't absorb any of this because we have prices going up elsewhere, including internally, and so you guys have to bear this. You can imagine if our products are competing with similar products from other parts of the world, and they have more headroom to go down in sort of prices to adopt or adjust to the reciprocal tariffs, then of course we're going to lose market share. I'm giving you all that in one mouthful, because it means that although there's this sort of price adjustment taking place, there's also the competitive pressures. That's one type of adjustment where the guys are saying, we can't do this, you need to take all of it. And we have had some industries and sectors where they've had to reduce their prices, and hence their earnings have been reduced as a consequence of the reciprocal tariffs. The second pattern is where we have some sectors saying, look, to be fair, we know this is as hard on you as it is on us. Let's go 50. And I can tell you, I can actually call one of the sectors broadly because there's so many exporters from CARICOM, it's not going to indict anyone. It's fish and fish products. For fish and fish products, we've seen sort of that Solomonic split between the purchasers and importers and the exporters, right? But we've not had the reverse. We've not had any instance where the US guy is saying, look, I will take all of it. You don't worry. We've not had any of that. And that's a measure of where the net impact will be. The net impact is certainly going to be on our side. Yes, the impact is on the purchaser in the United States, the consumers. And at the retail and distribution level, we've also spoken to a couple of the entities that distribute. that engage in the trade, the supply chain, at the domestic level for goods that are sourced in the Caribbean. A lot of them are actually showing quite a bit of resilience in terms of trying to adjust margins so that they don't pass the full impact on to consumers. You're absolutely correct in what you said. That can't go on forever. And so we expect that the full effect of this, we have sort of estimated that because distributors and retailers don't want to be adjusting prices every week or every month, they're waiting to see where the president settles with the next round of discussions, negotiations even with the countries, and where the tariff settles before they ultimately move to a price level that's going to be sustained. So we expect some more adjustments coming from that. In the meantime, more diaspora in the US, a lot of them consuming Caribbean products, have been one of the first groups to be hit, right? You think about a chap who, although he lives in the United States and, his patterns are still largely Caribbean. So he still buys yellow yam, he still buys a lot of the products that we export from the region. They're the ones that are seeing sort of the adjustments taking place a little more rapidly for Caribbean products. I want to be clear, because there are other countries which are going to have, it appears, tariff levels greater than 10%, right? So all of that shaking out, and all people are also consuming some of those products. So, all told, it's really not a good time for Caribbean economies and for Caribbean people, because on the other side, clearly on the import side, I know you'd want to go there, there are also some implications for us, not just on exports, because our study has focused heavily on exports in the first instance, but we already know, because we've been talking to the Caribbean Hotel and Tourism Association, we've been talking to importers, we already know that in some countries, right, we've started to see some effects on the import side. But I wanted you to just get a good sense that on the export side, we're net losers, and that the incidence of this is that our revenue is going down and the price split. And where it takes place is 50-50, but we don't have anyone taking the full hit. We are taking the full hit in many instances.
So in terms of, all right, for some of the countries in this region, because one of the levers that we always had would have been exchange rate adjustments, if you want to go that route. Politically, I'm not sure if that is a feasible option for most of the Caribbean, to be honest with you. But from a practical standpoint, how many effective levers do we really have in treating with this current dynamic as a region?
I think we have a couple levers that we haven't leveraged yet, but it's going to take speed of adjustment, decisions, and deliberate leadership by heads, because I am speaking first and foremost, when I mention speed of adjustment and political decision by heads, to the opportunities within the CSME. There are large opportunities within the CSME for us to displace, and we've actually done the analytical work on this in the CPSO, to displace imports. Not all of it, but there are 300 and something product categories that we've recognized there's an opportunity to displace imports. Now, interestingly, a lot of these still depend on intermediate inputs from the United States, to be clear.
Of course.
Which is why I said that we are so coupled in our trade and production systems. But at least there's value on top of that where we can get more production, more trade, more employment, more investment. There are some products, which is the second category, which is the second sort of scope that we have, the flexibility you've asked about, which is to source from other countries. There are countries that are in this hemisphere, and we've been looking at some of that as well. We have to, because there's some industries that are going to be so hard hit. Those that essentially use a lot of intermediate inputs that pass through the United States. And this is important for your listeners. About 19% we've estimated of the imports that we actually, demand in CARICOM, that they pass through the United States, but they don't originate in the United States. Other colleagues have estimated between 10 and 12%. We've looked at a number of other parameters to look at where that quantum is. But even if it's 10 or 12 or 19, it means that quite a bit passes through the United States. And so if the US tariffs, for instance, on the Philippines or on China or some other country is greater than 10%, It's going to impact us by even a larger degree than we now see, which is where we have a 10% across the board, sort of, except for some steel products from China and some exceptional products from Canada. So for those products, we believe that there are opportunities to import from other countries in Latin America. Some of them, we found there are good import opportunities in Brazil, in Mexico. We found good export opportunities for some of these products in Costa Rica. Interestingly, there's some Caribbean countries some Caribbean, though non-CARICOM countries that we've looked at, and we are surprised that the extent to which they can displace some products from the United States is not very large. But we shouldn't be surprised when we did a double think, because their trade and production systems are quite similar to ours. They're competitive, right? But that work's been undertaken. But the sort of takeaway for your program is that the second opportunity is for us to source from elsewhere. And I think the third opportunity in terms of what we do with the monetary and fiscal instruments, certainly on the fiscal side, there's a little adjustment that we can take, knowing that it will have an impact on revenue and the government's expenditure on economic and social programs. So that's really a tight balance. So we're not seeing that as a long-term fix. On the monetary side, sure, you can get some short-term benefits from exchange rate adjustments, but that will dissipate over time. It's fleeting, particularly if it's not anchored in the first area of flexibility I spoke about, particularly if we don't see the response at the CSME level, right, in the short run to actually fill the gap. It's going to be fleeting. So I think the region's in a very difficult place where we have to make some deliberate decisions. And one of those decisions, to my mind, that is most important is for us to get rid of all of the barriers to trade, so that, for instance, Jamaica broilers, Caribbean broilers and others that see opportunities where small volumes are imported by small countries from the United States can themselves do that and really engage, knowing that there are no non-tariff barriers that they have to mount. And we've seen that it's a time for us to, which is why I spoke about political leadership, right? And then there's another thing we need to do if we want to really have the adjustments that you spoke about to compensate for this. And that's on the labor side. You know, all of the countries have labor problems. It pains me when I look at the agricultural sector and I see so much of the agricultural sector that depends on labor availability, right? Essentially, you know, going wanting. We can't sustain production. Volumes are falling. And in some cases, crops are on the tree because we don't have labor, right, to harvest or to sustain production. And so you have some unemployment in some countries. You have underemployment in other countries, and we're still hithering and tithering. We've had some bright spots, just bright spots recently, but that's really been a big humbug for the private sector. So all of this goes right back to what we need to do. And if anything, you know, I don't like to say this, but the reciprocal tariffs are forcing us to do some things we should have done anyway. It's just making it more urgent. And unfortunately, it's come to this, but I'm not celebrating it, nor am I recommending it, nor am I holding it up as a flag. I think as developing countries, it is certainly, it upends the trading system. And it certainly undoes in a very vicious way a lot of the sort of patterns of, you know, concessions we've granted to developed countries, to our markets and our people and our resources and so on. So I'm not holding it up. I'm just making the point that it now behooves us to do that which we ought to have done all the time more rapidly.
Yeah, no, fair point. And therefore, as you raise the issue of the labor, I take it into the other aspect of it that I wanted to raise with you. And that is in terms of the recent announcement about free movement of labor within the region. Now, Patrick, I'll be very honest with you. I'm one of those people who I view that announcement as just an exercise in incrementalism, because I don't see, to be honest with you, after 40 years, I don't see why we're still speaking about the skills certificate. We're still speaking about all of these other issues, including basically what some of us would argue is almost the structural exclusion of Haiti from this free movement exercise. And when I juxtapose it against what is said now, about in terms of the agriculture, your need for workers, etc., etc. We're still operating in a suboptimal way. The obvious question then is, are we really serious?
Yes, Joe, it goes right back to my first point, speed and urgency. I have to tell you that one of the first points that the private sector rallied around in accepting the call to form a CARICOM private sector organization in 2019 when they met in Port of Spain, one of the issues that rallied every single executive that was invited to that meeting from every CARICOM country,
right.
The rallying cry was, if we could get one thing, just freedom of movement of persons in CARICOM achieved, this organization, as they saw it in 2019, would have achieved this objective. Yes, we want to achieve more. But if there's one thing we all want to see, is this freedom of movement regime. And so we have been on pause, urging, but being politically polite.
No,
in not upsetting the policy process and the political process that heads tell us. They have to balance delicately internally. Notice my language is deliberate, because I want to make sure that I represent my colleagues properly. This is my executive committee. But we have every single year called for full freedom of movement. And the private sector believes that once persons enter the economic space that is the CSME, and they do so in pursuit of economic opportunity, and they can demonstrate that, we ought to let the regime function. We need to let the regime determine when wages are high enough to attract people, because people are intelligent, and the working conditions as well. And if we do that, we think we're going to have a CSME that makes sense. What we don't think is going to continue acting in our favor is where a young engineer has to wait 6 months. And let me tell you that I can speak to this with authority and passion. Young Grenadian engineer comes to Trinidad and Tobago or Barbados, and he thinks, because he's read the thing and believes that with a certificate, so he gets it, that he can enter one of these countries and apply for a job and work, as they would say in the small islands, joke making. He then has to submit this certificate so that it's verified. And that verification process, right, which has certain steps in there that are similar to the process he went through to get the certificate in the first instance in a couple of the countries. That process can take a month, 2 months, right? But in many countries, he can only do that. I want to be clear, and I can speak to this because we're going to document it after he gets a job offer. But to get the job offer, concretely, they need to know that he is able to work. And so if the employer isn't flexible, you're caught in this sort of time warp. And my colleague at the CARICOM Secretariat, when I was explaining this to him, he was a little beamish. So I actually gave him evidence of the case we're talking about. And after that is done, then he goes back and he gets, the authorities to say, yes, you can work, and he's able to do some, leaving out the steps about poor young man, not knowing that, believes that he can stay in the country and look for a job, takes him 7 months to get the job, and when he gets it, he finds out from the authorities that he's overstayed. Exactly. I'm not going to go into those murky waters. All I'm saying to you is that I'm appealing to the community that we cannot continue to treat our young people this way. Let me juxtapose this for you. That this same young man, under President Trump's policies, can leave school, get a job, and be working inside of a month, as he was.
Yeah. But
decided that he wanted to come back to contribute to the region, and he was really, bound up in this, this euphoria of a united Caribbean, and that's what we're facing. And I'm just making the point that it's not just what we do in CARICOM, is that our young people are finding that whether it's in the UK, or in the US, or in Brazil, or in Costa Rica, or in the other parts of Europe, that the facilitation that they have to work and to move is a lot easier than in the countries and the region in which they were born. And many of them are still very strongly associated. So it's more than just an economic thing, right? What we're facing is a situation where our civilization and our heads have to understand that we are discouraging young talent.
Exactly.
And we can't intend to build a serious society rapidly if we continue with this. So we applaud Barbados and Belize and St. Vincent and the Grenadines and Dominica. We certainly applaud it. But we think it is a parsimonious approach like you. We think we need to move more rapidly, and we've actually called on full free movement by the 31st of December. And this is after we had commitments before, only to say that we're not fighting with governments. We just know it is good for business, it is good for the society, and it is good for building our Caribbean civilization. We're very clear on that as a private sector.
But Patrick, the obvious question, we just won't have to wrap this up, but the obvious question is simply this, that one, first of all, because not just those four countries that obviously, but what we're looking at is a scenario where one, you have the local content legislation out of Ghana, where they got a 5 to 7 year exemption from this process, which frankly speaking makes no sense, because it can be argued that part of the challenge with the local content legislation out of Ghana is that it's actually in breach of the Treaty of Chaguaramas. And then from the other standpoint, from the OECS countries, where there is absolute free movement between the countries, between the members of the OECS, because they are members of CARICOM, under the MFN clause, the most favored nation clauses, their right for should have been passed on to all the members. So I, for the life of me, don't understand what the hell are we talking about, what we're arguing about, and what we're negotiating. Because it becomes, if somebody mounts, I would dare say, if somebody mounts a legal challenge to this, people will find themselves in problems, because I don't know how you can then argue on both sides of a conversation.
Yeah, I think we do have a few contradictions in the single market. I think the contradictions, we have to move more swiftly to work them out. I think some of the frustrations that the smaller partners, LDCs, particularly the OECS, feel with the process are nothing but, if you wish, avoidable grumblings that a single market must find a way to get around, and we're not hiding this. We feel, for instance, not just the freedom of movement of labor, which you're absolutely correct on, and I'm saying that has to work itself out, and they need to huddle and do this. But from the small countries' perspective, the fact that when they trade goods in certain of the big markets, they can't get paid is a major issue. And I have to say that, lest it be taken as a political comment, it's not. In the study that we did, which is still, you were there, it was your shop that commissioned the study, where we looked at business facilitation in the CARICOM. This foreign exchange restrictions was picked up as one of the big non-tariff barriers. And we actually used the, classification systems just because we wanted to be sure that everyone understood that it was rules-based and rooted in a sort of a methodology that was well understood and well accepted. And this is since 2017, 2018, that study. So when Prime Minister Gonzalez and others bring it up today, it is real. And I make the point, just as we wrap up, that it is so real that it's actually slowed down trade from those countries in terms of their exports into CARICOM. And it is so real that the impact is greater than the impact of a 10% reciprocal tariff from the US. And I will tell you that we've measured this. If you export, for instance, and you can't get paid along the official exchange rates and you have to buy at a premium, you're paying between 15 and 20% up on the premium, right? If you're lucky, right? That, of course, if you're trading an agricultural product where you're working with margins at 25%, you are not even treading water anymore, right? Because if you take spoilage into account, and we've said this, and I'm saying it because I want to be clear that we have to find solutions to these things. A spoilage rate of 7%, and you put it on top of that, you're underwater. So the traders have done what the economists don't need to tell them to do. They've stopped trading because it's unprofitable.
Yeah.
And so I think that's an easy fix, because the central banks can get together and put a pool of funds together easy. It's not a lot, 10 million US dollars. And to engage in it, you must be an agricultural exporter or an exporter from those countries into this country. And so what they do is they take the currency domestically and give them the US dollar, and it just circulates. It's not a hard problem. And I think we just need to have the politicians get together, or heads get together, and find some fixes to these things that are nothing but humbugs to the integration process. Now, everything we talked about when you started this on the America First policies and what we could do, I doubled down on the fact that we need to drive intra-regional trade. But I finished by saying that if we don't fix freedom of movement and we don't fix NTBs, including foreign exchange restrictions, and we don't fix some of the other nuances and disturbances that attend to the process, everything I spoke about in terms of getting the opportunities and countering what is in fact going to be the impact of the America First policies in part or in whole, and we would not be in a position to do. And so we've come full circle with this.
The conversation continues, Patrick Antoine, as I thank you very much for your participation today. Patrick Antoine, who is the CEO and Technical Director at the CARICOM Private Sector Organization. Patrick, as always, it's always a pleasure to speak to you, my friend. Thanks so much.
Joe, to you and your team, thank you for having us, and we look forward to being back when you invite us. Cheers. Have a good day.
You too.
In a world of constant change, insight is your greatest asset. At Joseph Cox and Associates, we empower innovation across the Caribbean. Whatever your challenge, we can help. We're proudly customer-centric, offering bespoke solutions tailored to every partner. From innovation and digital transformation to leadership and policy, our services are designed to deliver lasting impact. We partner with leaders across sectors, from finance and government to energy, tech, and infrastructure, helping them navigate complexity with confidence. Our work is grounded in collaboration. We connect regional leaders through powerful networks, driving change through joint research. Discover more at josephcox.org. Joseph Cox and Associates. Insight, experience, impact.
Welcome to Market Watch. I'm Claudine Lloyd, bringing you the latest economic and financial updates across the Caribbean and beyond. In a landmark ruling, the UK Privy Council has held that shareholders can't access internal legal advice in merger disputes, affirming legal privilege over the long-standing shareholder rule. The decision strengthens board protections and reshapes future valuation challenges across the Caribbean and UK jurisdictions. The IMF now expects GDP growth in Latin America and the Caribbean to slow to 2.2% in 2025, down slightly from 2.4% in 2024, before edging back up in 2026. Global trade tensions, currency swings, and weakening demand from advanced economies continue to cloud the regional outlook. Notably, Brazil's growth forecast have been revised up to 2.3%, while Mexico lags at just 0.2%. Jamaica is stepping up its global logistics ambitions. The Port Authority will invest $50 million in expanding Kingston's port operations next year, complementing the $80 million Westland expansion already underway. Since the lease to KFTL, cargo volumes are up 40% and over 500 new jobs have been created. The nearby Cayman Special Economic Zone is also moving forward, integrating warehousing and logistics into a broader trade strategy. In Trinidad and Tobago, the foreign exchange shortage remains acute. New central bank Governor Larry Hawaii is focusing on long-term reforms, including a unified payments interface, but admits sustainable forex balance is still distant. Meanwhile, unregulated forex markets continue to squeeze SMEs, driving up operational costs and market risks. Moody's has reaffirmed the Caribbean Development Bank's AA1 credit rating, citing strong capital buffers, low leverage, and reform momentum. The CBD's $450 million US dollars exposure exchange with CABI, along with a pending Canadian guarantee, is expected to reduce concentration risks and boost resilience in the face of climate and credit pressures. Dominica is eyeing 4.2% growth in 2025, thanks to robust infrastructure investment and improved tax collection. However, with 58% of revenue still tied to its Citizenship by Investment program, vulnerability remains. In the Bahamas, growth slowed in the first half of 2025, but lending rose and loan delinquencies eased to 5%, reflecting stronger credit conditions. Inflation turned negative, with energy price declines driving deflation. Grenada exceeded revenue targets with 527 million EC dollars collected through May, but still fell short of 2024's haul by nearly 100 million EC dollars. Fiscal performance remains within annual limits. Barbados reported a 15.6% drop in goods exports, led by oil and chemicals, but services grew 4.3%, and tax revenues surged to $1.2 billion in quarter one. The government ended the quarter with a 2.4% fiscal surplus, on track to reduce debt by 60% of GDP by 2035. In a historic deal, Afro-Exim Bank is injecting 140 million US dollars into Bahamian infrastructure through a partnership with the Bank of the Bahamas, signaling deepening Afro-Caribbean economic ties. Offshore reinsurance surged to $1.1 trillion in 2024, with Bermuda capturing 84% of ceded U.S. life reserves, raising regulatory red flags. PwC has been tapped to lead the feasibility study on a CARICOM regional stock exchange, aiming to transform capital access across the bloc. And in corporate news, VM Group's net profit soared 174% to 1.59 billion Jamaican dollars. JMMB posted 10.1 billion Jamaican dollars net profit, while Lasco Manufacturing earned 618 million US dollars despite cash flow strain. Before we close, let's take a quick look at the region's currency and stock market movements. On the foreign exchange front, the strongest currencies in CARICOM remain the OECS dollar at $2.71 per US dollar, and the Barbadian and Belizean dollars, both hovering around $2.02 to $2.03. The Jamaican dollar trades at $161.25 to the US dollar, while Guyana's dollar stands at $218 and Haiti's gourd at $131.47. Suriname dollar trades at $37.18 and Trinidad's dollar at $6.78 to the U.S. In stock market news, the Jamaica Stock Exchange climbed 0.46%, led by a 13% jump in Stanley Motor and 7.9% from Mayberry Group. Trinidad's all TNT index dipped slightly by 0.06%, while the Bahamas BISX and Barbados BSC and Caribbean exchanges all posted modest gains. Top decliners this round include Guardian Media, down 12.4%, and VM Investment, off 3%. That's it for this edition of Market Watch. I'm Claudine. Stay informed, stay ahead. Global Pulse is up next. This is CBR. From Washington to Brussels to Beijing, this is Global Pulse. I am Claudine Lloyd with your roundup of this week's top global economic, trade, and financial headlines. The IMF now projects global growth at 3% in 2025, edging up to 3.1% in 2026, with headline inflation easing to 4.2% next year. The outlook is lifted by front-loaded trade, looser financial conditions, and a weaker U.S. dollar. But risks remain, from tariffs and fiscal stress to geopolitical volatility. Advanced economies will grow just 1.5%, while emerging markets led by China at 4.8% and India at 6.4% are expected to drive momentum. On July 27, the EU and US struck a landmark trade pact, capping most US tariffs on European goods at 15%, restoring pre-2021 levels on aircraft parts and unlocking 5 billion euros in EU duty savings. It also secures 700 billion euros in EU energy purchases from the US. Meanwhile, President Trump's tariff spree continues. A 25% tariff on all Indian goods begins August 1. 50% tariffs on Brazil take effect August 6, and 69 countries face new duties up to 50% starting August 7. Global market reaction, sell-offs, supply chain worries, and renewed recession fears. The U.S. economy rebounded 3% in Q2, but underlying demand is weakening. Consumer spending rose just 1.4%, and job growth in July added only 73,000 jobs. The Fed held rates steady, citing tariff-driven inflation, now at 2.6%, with September cuts now uncertain. In Canada, GDP dipped 0.1% in May, but a modest June rebound could avoid a full Q2 contraction. The Bank of Canada held rates at 2.75%, wary of U.S. trade headwinds and falling exports. The Eurozone beat growth expectations, expanding 0.1% in Q2, led by Spain and France, while Germany and Italy contracted. The ECB is now less likely to cut rates further this year. In Asia, Toyota posted record H1 sales, with hybrids now making up 43% of output. Meanwhile, China's home sales plunged 24% in July, deepening concerns over long-term demand as property stimulus remains elusive. Now for headlines to watch. The U.S. ends tariff exemptions on imports under $800, impacting over 1 billion annual shipments from e-commerce giants like Shein and Temu. South Korea secured a trade breakthrough with the U.S., unlocking $350 billion in investments and reduced tariffs. The U.K. unveiled sweeping SME reforms, mandating 30-day invoice checks and empowering regulators with multi-million pound fines to curb late payments. And the World Bank is launching securitization pilots to bundle infrastructure loans, unlocking private capital for development. Before we go, let's take a quick look at energy prices and global stock market action. In energy markets, oil is under pressure. WTI crude slipped to $67.33, down 2.79%. Brent crude dropped 2.83% to $69.67, both reacting to demand concerns and tariff tensions. Only the OPEC basket posted gains, up 3.76% to $75.34, as some producers signal tighter supply. Natural gas edged down slightly to $3.08. Across global equities, red dominated the boards. In the U.S., the Nasdaq plunged 2.24% and the S&P 500 fell 1.6%. Europe fared worse. Germany's DAX slid 2.66% and France's CAC 40 lost nearly 3%. In Asia, Japan's Nikkei held relatively firm with a 0.66% drop, while Hong Kong's Hang Seng slipped 1.07%. Markets are reacting sharply to Trump's sweeping tariffs, trade uncertainty, and softer economic signals worldwide. I am Claudine Lloyd. That wraps your global market snapshots here on Global Pulse. This is CBR.
Well, that's a wrap, folks. Now, my profound thanks to you for your continued engagement with this program. Your comments, notes, etc., are well received and truly appreciated as we continue to build out this platform. Today, we also wish to express our profound thanks to Dr. Patrick Antoine, who is the CEO and Technical Director at a CARICOM private sector organization, where we engage in a conversation really looking at rethinking Caribbean integration through the prism of trade and transformation, of course, cast against the background of the ever-changing tariff environment in which we all operate. Now, we discussed the evolving dynamics of trade, labor, and of course, regional strategy within CARICOM. And some of the key points that I really want to just highlight here is one, I think the matter of the Caribbean region faces significant losses due to the new tariffs. Pricing adjustments are being made, but of course, obviously, the burden often falls on the exporters given within this region, to be honest with you. Non-tariff barriers, we also touched on that issue, and including foreign exchange restrictions, which are seriously hindering trade, particularly among some of the smaller countries. And finally, the private sector is calling for full freedom of movement by workers by December 31. 25. Now, I thought it was a really profound type of conversation, and one that really and truly, with this country, this region, really needs to engage in far more of these conversations. We look at the real issues, not so much, some of the superficial types of conversations, but look at real issues. Just to advise you that the new edition of the Caribbean Financial Dispatch is now available. And as per usual, if you wish to avail yourself of that publication, you can simply drop us a note at Caribbean Business Review at gmail.com, or you can simply go on josephcox.org, the dedicated CBR page, and avail yourself of the offering there. As per usual, we invite you to like, share, and subscribe to this broadcast and follow us on our social media channels, TikTok, Spotify, LinkedIn, WhatsApp channels, YouTube, among others. We're also grateful to our friends at MKR Radio for their continued engagement and support. And indeed, that being said, until next week, same time, same place, I remind you that my name is Joseph Cox and that this has been CBR.